On this slide, you will find an illustration of power of compounding. A graph of returns from investing 1 lakh rupees across various time periods and interest rate is shown on this slide. If you invest 1 lakh rupees at a 5% interest rate for 20 years, you will only receive 3 lakh rupees. On the other hand, if the rate of return is 15%, your 1 lakh rupees can grow to 17 lakh rupees after 20 years. So you can see the difference in amount received after 5 years in both the cases is small. However, the difference goes on increasing as you keep invested for longer time. This clearly illustrates the power of compounding. Being an engineer, you can see that the slope of the return line rises as the length of investment increases. As the total amount grows, the return on it also grows, which causes the slope to rise as the length of investment periods lengthens. Hence, when it comes to compounding, starting early is very important. This is one more illustration. If you start with 10,000 rupees, that is very much possible, and continue to invest 7,500 rupees per month, and the rate of return is 12%, which is a typical rate of return for large cap mutual fund, you will have more than 1 crore rupees after 25 years. This is how compounding works. A 12% return is definitely feasible with use of equities or mutual fund. So in upcoming sessions, we will go into more details about investing in mutual funds. This is the illustration to demonstrate the importance of start investing early. Miss X and Miss Y are investing rupees 6,000 every year at a rate of 7% every year, not every month, which is a common interest rate offered by banks on fixed deposits. Miss X began investing at the age of 25, while Miss Y began investing at the age of 30. Miss X will receive 15 lakhs rupees at the age of 67, whereas Miss Y will receive around 10 lakh rupees at the same time. Miss Y has put 3.6 lakh less than Miss X. However, because of this, she will lose nearly 5 lakhs rupees when she retires. Here I am assuming the retirement age is 67. So make sure that start investing as soon as you earn your first salary. Here the calculations are based on yearly investment. If you consider monthly investment, the difference would be very, very high. Now, before investing, what you should know, let's see. So why we invest? Investment plays a vital role in supporting your financial needs during periods of no income. By allocating a portion of your earnings to investment, you enable your money to grow and work for you. When considering any investment opportunity, three key parameters should be assessed. The first is return, the second is safety, and third is liquidity. Investment avenues can be broadly classified into groups as asset classes. One of the most popular asset class is equity. So asset class is the area of investment. So equity is asset class, real estate is asset class. We will see more about asset class on the next slide. An asset class is a group of different financial investments that have some things in common, like how far safe they are, how much they can earn, and how easy to turn them into cash. So every asset class represents the same characteristics. Each asset class behaves similarly to others in certain situations. Some do well when the economy is doing great, while others may perform better when the economy is not doing so great. To make smart investment, it is essential to spread your money across different asset classes because your money has to work all if the economy is working for you or if the economy is not working for you. This way, you can reduce the risk of losing all your money if one investment doesn't do well. So, in booming economy, equities do well, and when the economy is not going so great, then the bank deposits and the bonds, government securities do well. To make smart investment, it is essential to spread your money across different asset classes. This way, you reduce the risk of losing all your money. The process of dividing your money among various investment is called as asset allocation. By doing this wisely, you can create a balanced investment plan that matches your financial goals and how much risk you are comfortable in taking. For example, if you want to be cautious, you may put more money in safer investment like bonds or saving accounts. But if you are willing to take more risk, that might invest you might invest more in things like stocks or real estate that have the potential for higher rewards. Remember, understanding asset classes and choosing the right mix of investment can help you to reach your financial goals while making the risk or managing the risk effectively. So these are some of the asset classes. So the typical asset classes that people invest in are fixed income, real estate, gold, equity and cash. Fixed income asset class, this means lending money to government or companies and they pay you interest regularly. It is a very safe and predictable option like bonds and government securities falls in under this category. Real estate, investing in properties like houses or apartments, you can make money from renting them out or selling them later for higher price. Gold is a precious metal that people buy as a safe investment to protect against economic uncertainties. Equity means buying shares or stocks. When the company does well, the value of your stocks grows up and you can make money. Similarly, you can earn dividends also. The next asset class is cash. Cash investment are simple and safe. You can put your money in saving accounts. So by investing a mix of these asset classes, you can lower the risk and increase your chances of making money. You have to divide your money among these asset classes depending upon your goals and how much risk you are comfortable in taking. The fixed income asset class includes bank deposits, government securities, government bonds, and corporate bonds. These investments have set time period and predefined rate of return. Because the returns duration are fixed, they are considered the safest type of investment. However, the downside is that fixed income investment often have lower returns. Sometimes the returns may not even be enough to keep up with inflation, which means the value of your money does not grow as much you like them to grow. The next asset class is equity. This is one of the most popular ways to invest money. Investing in stocks can give you very high returns, sometimes even 100% in just 1 year. However, it is important to know that this type of investment comes with lot of risk. If you want to invest in stock, you should be well educated, well informed, and you should know how market works. You need to keep close eye on stock prices and sell them when the price goes up. Then you can buy more stocks when prices go down. So when prices go up, you have to sell, and when prices come down, you have to buy. So you have to be continuously vigilant if you want to invest in stocks. This kind of investment is best suited for experienced investor who have done it before and understand the risk involved. If you are new to this investing, it's better to start with safe options first. Gold is one of the oldest and most cherished way of holding asset. People all around the world love gold. Even in India, people love gold most. And even central bank keep some of their reserves it to stay stable. So part of the asset of central bank is in form of gold because that is accepted all over the world and it has high liquidity. You can sell the gold and immediately raise funds. The investment in gold is can be made in different ways. You can buy physical gold in form of coins, bars or jewelry. It's nice because you can see and touch it. Digital gold, you can invest in gold through sovereign gold bonds and hold them in your demat account digitally. There are gold mutual funds. You can invest in gold through mutual funds, so that avoids the risk of holding the physical gold. Now let's look at the pros and limitations of investing in gold. Gold's value generally goes up over time, making it good long-term investment. That's very good thing about gold. Gold can protect your money from losing value due to inflation. In inflation, gold prices doesn't go down or gold prices increases even. You can easily turn gold into cash when you need it because it's widely accepted everywhere. People all around the world love gold and respect gold, so it's safe investment. Now there are certain limitations of investing in gold. Buying physical gold or investing in gold funds can be expensive at first. You need a lot of money to buy gold. For the best return, you need to keep invested in gold for longer time. This might not work for everyone. If you buy gold in form of jewelry, it might not be the best investment because it can be sold for less as you have to pay making charges. In short, gold is a well-loved asset that has shown long-term growth. It's a great way to protect and grow your wealth. Just remember to think about your goals and how much risk you are willing to take before investing in gold. The next asset class is cash. Cash is an essential part of any investment portfolio, even though it is usually earns lower returns. It acts as a safety net and crucial for emergencies. A general rule is to keep 3 to 6 times of your monthly expenses in cash or cash like assets as emergency fund. So how much money you should put in your saving account? 3 to 6 times of your monthly expenses, not monthly salary. Example of cash asset are hard cash in bank account, foreign currencies like dollars or euros, flexible fixed deposits that allows your money to convert into term deposits and you can withdraw them whenever required. We will discuss more about it in next few slides. Liquid mutual funds. Now there are certain pros and cons of cash asset class. Cash is the safest form of investment as there is no or little risk involved. Liquidity, cash is highly liquid, meaning you can access your funds quickly and easily when needed. Cash can work as emergency fund. In emergency, cash you can use cash. Now there are certain limitations. Cash usually earns lower returns compared to other asset classes like stocks or real estate. There is an inflation risk. Over time, the value of your cash may decrease due to inflation, which means your money may buy less in future. The next is opportunity cost. By keeping too much money in cash, you miss out on potential higher returns for other investments. So in summary, cash is a crucial part of well-balanced portfolio as it provides safety and accessibility in times of need. However, it is important to strike the right balance between holding cash for emergency and investing in other assets to achieve better long-term growth. Now, there are many ways you can invest your money to make it grow. Some popular options include bank deposits, stock, mutual funds, bond, government securities, and gold. In this course, we will talk more about investing in mutual funds and to some extent stocks. You probably already know about bank deposits. We will cover the different type of bank deposits that can be used as investment, but briefly. Now remember, all these investment options have different level of risk and they come with potential rewards also. On the chart, you will see risk and reward chart, risk on the horizontal axis and reward on the vertical axis. Here is the rule of thumb. Higher is the risk, greater the potential reward. Bank deposits, public provident fund, post office schemes and national savings certificates are considered as low risk and low return investment. They are very safe but the returns are not very high. On the other hand, if you are willing to take more risk, you can invest in higher return instruments like shares or stocks. As a smart investor, you should be cautious about schemes that promise unrealistic returns. These schemes are known as Ponzi schemes and they should be avoided because they are often fraudulent. These schemes may claim to offer low risk and high reward, but in reality, no legitimate scheme can provide high returns and low risk, except for real estate investment in prime location in big cities. So if you have a flat or office at Malabar Hill in Mumbai or Deccan Gymkhana in Pune, it can give you better returns at very low risk. So always be careful and do research before investing. So let's discuss about bank deposits that can be considered as investment, but it will yield very low returns. Bank deposits are fixed income asset, which means they provide a regular and predictable income to the investor. There are two main types, fixed deposit and recurring deposits. The deposits are considered the most secure among all investment options. They offer high level of safety because banks are regulated and insured, regulated by RBI, reducing the risk of losing your money. One advantage of bank deposit is that they offer non-negotiable returns, means the interest rates are fixed and known to the investor. So in investment like stocks, you don't know how much you will earn. This predictability can be reassuring for those seeking stability in their investments. However, downside is that the return from bank deposits are often low and may not keep pace with inflation. As a result, purchasing power of money invested may reduce over time. Additionally, the interest rate earned on bank deposit subjected to taxation. You have to pay TDS, tax deducted at source. So that further reduces the overall returns. In summary, bank deposits provide more secure and fixed income, but they may not be the best option for beating inflation or maximizing your returns. These are the different type of bank accounts or bank deposits that you can use. You might be aware of these type of bank accounts. One of them that is new to you is flexi deposit account, which combines feature of saving account and term deposit. To open this account, you typically need to keep minimum balance of around 10 to 25,000 rupees in the bank. In State Bank of India, the minimum balance is 25,000 rupees. Any additional money you have above this amount automatically becomes term deposit. When you need to withdraw more than 25,000 or that more than your minimum deposit, the term deposit is used and you get the money. With flexi deposit, you earn interest similar to the term deposit on the money in your savings account. Otherwise, interest earned in saving account is very less, like 3 to 4%. You can withdraw the term deposit anytime, like your regular saving account. This account gives you the benefit of savings account as well as term deposit, making a good choice. The second type of deposit account is called as term deposit. Colloquially, in common man's language, we call it as a term deposit. It has different lock-in periods ranging from 15 days to 5 years. The interest rate for term deposits are linked with the policy set by RBI, that is called as monetary policy. These interest rates are usually enough to beat inflation. However, any interest earned on term deposit is taxable. The third type of deposit you can consider for investment is recurring deposit. With this account, you contribute money regularly at set interval, generally monthly. The account earns interest on money invested during its duration. If you are starting to earn your first salary, I encourage you to open a flexi deposit account or convert your existing saving account into flexi deposit account. It can be a smart move for your savings and investment goals. You can start recurring account also. So that's all for this lecture. In next lecture, we will discuss about more investment options. So thank you for your attention. See you in the next lecture.